We've known about global warming and what greenhouse gas emissions can do and the impact that they have since the 70s. But really, it took until 2015, until the Paris Climate Accord, the world finally agreed that they really need to do something about it. What that something is basically we need to reduce emissions. Simple as that. The challenge is that is going to require a massive behavioral change.
Yes.
So we really need to learn how to go about our lives, how to go about consuming and generating energy differently in a very, very massive way.
Welcome to the Tao of Chao podcast. This is a podcast about macroeconomics, geopolitics, global finance, investment themes, retirement planning, and behavioral finance, where we will try to find balance and provide a clearer path forward in this uncertain world. Today, my guest is my friend, Klaus Thuerbach. He is a co-manager and co-CIO at Klima Capital, an environmental investment manager. Klaus is a carbon and commodity market expert. And prior to Klima, he spent 10 years at PIMCO. Actually, that's where we met. And most recently as the lead strategist for commodities. Since 2018, he has focused on the carbon markets and played a principal role in building out PIMCO's carbon investment efforts, including launching a physical California carbon allowance fund. Klaus holds a MBA from Wharton. And with that said, hello, Klaus.
Thanks again for having me.
When I learned about you, really focus now solely on carbon, I thought only carbon I know is in fuzzy Coca-Cola or drinks, that bubbly stuff. And I really need to learn more about it. And I thought it would be great to have this conversation. So thank you for being here. So before we get started, kind of like talk a little bit about your firm's trading and managing carbon credits and all those more sophisticated stuff. Let's talk a little bit about the whys and the hows of investing in carbon credits. And first, I guess to help me better understand all the different ways that government entities are doing around the world in their attempt and approach to limit global warming. So please, maybe we should get started there, if that's okay, Klaus.
Yeah, absolutely. What you mentioned about global warming, the challenges, greenhouse gas effect, that has huge implications on us. We've known about global warming and what greenhouse gas emissions can do and the impact that they have since the 70s. But really, it took until 2015, until the Paris Climate Accord, until the world finally agreed that they really need to do something about it. And what that something is basically we need to reduce emissions. Simple as that. The challenge is that is going to require a massive behavioral change.
Yes.
So we really need to learn how to go about our lives, how to go about consuming and generating energy differently than we used to in a very, very massive way. Just to give you like a frame of reference, if we want to have a chance to achieving our Paris Climate Accord goals, to get on that path, we would need to reduce our greenhouse gas emissions by more than 40% by the end of this decade.
Wow.
And so
that's huge.
It's really massive. Now, I mentioned, policymakers have finally coalesced around the idea that we need to do something here. And their challenge, their task is how to set that framework, how to change incentives so that the industry, so that, you and I are going to change behavior and ultimately are going to, change the way that we consume energy. And there's a couple of principles that they can apply, a couple of tools that they have, and the dominant tool that we're using today and increasingly using is to price the emission of CO2, to basically put a price on something that previously was free, and thereby to change incentives that then change behavior and lead all of us to consume fewer emissions, if you want.
It seems like raising children is like we reward them and to punish them. Sounds like that's how we change behavior. We are kind of rewarding individuals for doing the right thing, and perhaps punishing is probably a negative term, but really there's a price to pay if you continue certain behavior. Is that what you're talking about here?
That's exactly it, right? It's like Think about carrot and stick approach here,
Yeah,
and
exactly.
certainly putting a price on something that was previously free feels a little bit more like a stick. But so far, that's been the way that we have created systems around the world, and those are already meaningful in size and scale and scope. So if we look at the share of the world's population that is already exposed to a carbon price, we have about 1/3 of the world's population being exposed to a carbon price. And that 1/3 of the population is generating about 55% of GDP.
Wow.
So carbon pricing is already here. It's going to continue to grow in importance over the coming years, but it is already a reality.
It sounds like, to some extent, changes are being made.
They are.
But it's a question of the speed of that change, right? Because we're still spewing all that stuff. At the same time, we're trying to minimize it. How much time do we have, you think? I mean, we're talking about by certain year, by reducing it by a certain number. I'm not trying to be hopeless. I'm saying I'm trying to be realistic.
I think the answer is, and has been for the last few decades, that we're late, that we're behind, that we would have had to start sooner and do more. And maybe one example of that is that the Paris Climate Accord, the target, what we're trying to do is limit the increase in temperature versus the pre-industrial times to 1.5 degrees Celsius. Increasingly, there are more and more voices that are saying, look, like it's a great goal, but in all reality, like we're likely gonna miss that goal. So we should really try to focus on the 2-degree, kind of cap that the Paris Climate Accord set. But even that, like, are we gonna achieve it or slightly miss it? We got to run faster. That's the bottom line.
I don't mean to make it depressing. I'm just curious.
It is kind of. But look, we're all working on it.
Yeah, I understand. And let's talk a little bit sort of internationally, because obviously we all live under the same roof. In this case, a glass roof, right? The greenhouse gas is really a glass roof. And we often hear that, well, the current polluters and, they really need to do more. And we are doing this, but their stuff is going to come to us and they need to, in other words, everyone needs to do something and not just a third or 50% of the world. Is it getting more prevalent across the world or not yet?
It clearly is. I mean, obviously we have still a ways to go, but if you just compare today versus let's say 10 years ago, there's already a massive change in the share of emissions that is covered by a carbon pricing scheme, and that basically is part of a system that really incentivizes the reduction of emissions. And there's a few recent developments, especially coming out of Europe, that I think that are going to have a very positive impact on the global adoption of carbon pricing mechanisms. So yes, I absolutely believe that on a forward-looking basis, that speed at which we're gonna broaden the scope and breadth of these programs is accelerating.
If we focus on sort of the regular, I think you are calling them the regulated market. Mm-hmm. So far, there seems to be three main approaches that to reduce greenhouse gas emissions, seems like. And tell me if I'm right or wrong. So the first is to set a specific limit to a company cannot exceed. In other words, company A, you can't go beyond X, whatever that means. And love to hear your much more articulate way of explaining this. And number two is to introduce a carbon tax. If you spew so much carbon, you're going to be taxed or something like that, where the company pays the amount of the CO2 that they generate or produce. And then thirdly is to implement some kind of a trading scheme where, I didn't use enough or I used too much, I buy from each other, and sort of a supply demand type scheme, which is to create a carbon market for companies to buy and to sell. Almost like the right to pollute. I can pollute. It sounds silly, but I have to pay for my right to pollute the environment, something like that. Am I saying the three ways, or are there other ways?
You are. I mean, those are the three key ways that policymakers are trying to put frameworks in place for us to ultimately reduce our emission footprint. Look, before I go into those three in a little bit more detail, if you don't mind, maybe I can try to spend maybe a couple of minutes just differentiating the regulated from the voluntary markets in
great.
carbon space, because I frequently those terms sound so much so similar to each other that it's oftentimes quite difficult to differentiate. So when there's regulated markets and voluntary carbon markets, kind of the key difference here, like how I like to think about them, is the regulated markets are trying to reduce gross emissions. So they're trying to reduce the absolute emission levels. Said differently, they're trying to incentivize burning less fossil fuel. And regulated markets are basically government imposed. They're not voluntary. Emitters must be part of it, can't get around it. And there's very, very clear rules, regulation, laws that are governing that system. Next to that regulated market, sit the voluntary carbon market. And the idea behind the voluntary carbon markets is that CO2 is fungible. And if you emit a ton of CO2, that impact on the climate can be neutralized if at the same time you do some activity that removes a ton of CO2. And in super simple terms, what you can do is plant a tree, right? So as the tree grows, it sequesters carbon essentially. So that voluntary carbon market, the idea is that the net emissions are being reduced, but they actually allow continuing, to simplify, to burn fossil fuels and have gross emissions. But because of that positive activity, sequestering the carbon, the net emissions are going down. Mm-hmm. And so those are the two different markets. And the voluntary markets are, voluntary. Governments, regulators are not part of that. So they are very distinct markets. Generally speaking, you cannot use any activity that you do in the voluntary carbon markets to fulfill your compliance obligation in the regulated carbon markets. There's kind of exceptions around the edges, but for all intents and purposes, that's kind of how you can think about it.
So when since you brought that up, governments across the world, are they leaning more to regulated market because voluntary market, because it's voluntary, seems like it's harder to force anybody to do it, and it's kind of spotty. I'm just thinking out loud. I don't know the voluntary market. Is that a fair way to think about it? And does it mean that more regulated market is forthcoming? What's your thought on that?
Yeah, so I would say generally speaking, you can make that simplification that governments around the globe are favoring the regulated markets with the gross emissions reductions, and that in parallel there are these voluntary carbon markets that are primarily used by corporations that want to reduce their own carbon footprint. Mm-hmm. And oftentimes these are indirect carbon footprints. So think about a corporation that is using a lot of electricity. It might not be burning fossil fuels. It doesn't have direct emissions. They're called Scope 1 emissions. But there's indirect emissions because of the energy use, because the energy was generated somehow, and there might have been some natural gas or coal that was burned in that process, and that can be measured as Scope 2 emissions. And then oftentimes those are then used as the baseline for ultimately purchasing voluntary carbon market credits to then essentially offset that.
So let's turn to those. I mentioned three ways. Yeah. You said that's pretty much it. Tell us a little bit about each one, if you can, sure. And how effective you think they are. From specifying limits to taxing to then this marketplace approach or capitalist marketplace approach.
Right. So in short, there were regulation, taxation, or cap and trade. And if we start with the regulation aspects, I mean, that's something that's been going on forever. Governments are regulating all kinds of things. One example that we're all very familiar with is regulating the emission levels from internal combustion engine cars, right? And those levels have been tightened via regulation for many, many years now. And so basically regulation sets rules, binding targets to maybe an industry or a company or some emission source that they must comply with, irrespective of how much it costs to do that, how efficient or inefficient it is to comply with that new rule. So that regulation works. It works well. It is binding, right? Via regulation, you're essentially, let's say, guaranteed to meet your targets, your goals, your climate ambition. But the challenge is, policymakers might not be the best suited ones to pick those areas that are, efficient to decarbonize. So how costly is it to society to decarbonize via just using regulation? And the fear is that it's quite costly, and it would cost a lot of GDP growth and wealth and jobs if regulation was the primary toolkit.
Mm-hmm. Okay.
So that's that aspect. Then another aspect would be putting that price on carbon, putting a price on emissions, pricing something that previously was free, and you can achieve that via a fairly simple to execute carbon tax. You basically say, look, like for every ton of emissions that is generated, the emitter now needs to pay, let's call a number, $50 per ton, right? And then you change behavior. That incentive is going to have a real world impact. Market participants that previously have been freely emitting without thought are now going to think about, well, do I really need to do that task? Are there alternatives that I have that allow me to emit less? And so you're going to have a positive impact. The challenge with a tax is setting the right level. Because if you set the tax too low, you risk not achieving your climate targets. And if you set the tax too high, yes, you are achieving those targets, but chances are that also is costing you growth and jobs. So regulation, guarantees the outcome, but is highly likely an inefficient way of going about this. A carbon tax, more efficient, but doesn't guarantee the outcome. Setting the price is next to impossible to set the correct price. And that's really where the third method comes in, the third tool, which is these emission trading schemes or cap and trade systems. The way that they work is that basically the government, the regulators, define what industries are part of it. And then those industries are told and forced that for every ton of CO2 that they emit, they must have a permit to do so. So basically, one permit allows you to emit 1 ton of CO2. And the regulator issues those permits every year. And the regulator sets a cap or a quantity of permits that are being issued. And so per definition, because this is binding, that cap of permits issued is defined the total emissions that are possible in the system. Because if you don't have a permit, if you cannot get your hands on a permit, you may not emit. So it's a cap that is binding and hard, and therefore basically guarantees that you're reaching your climate ambitions. And now over time, how that system works is every year you're reducing the cap, you're reducing the number of permits that you issue, and thereby emissions must decline over time in line with that cap.
So the first thing is they set a not to exceed. You can only do 5 tons, whatever the number is.
Yeah.
And anything more than 5 tons, what happens? They put you to jail, or they have some punishment, I assume, right? They do something to you. It doesn't matter what it is.
Yes, exactly.
The second one is saying, we're going to have a carbon tax. So for every 1 ton you come out with, you had to pay us $5,000, or I'm just naming a number. Doesn't matter what that number is. So in a way, is trying to minimize the number of tons by charging you a tax. So that is a no carrot, that's only stick, right? The first one is only stick as well. There's no real carrot. Like, I guess the carrot is not to exceed. Then the third one is where you can get those permits and there's some value to it, it sounds like.
Mm-hmm.
And then you can cap it by the number of permit they issue. Sounds like those permit have different values over time. Sounds like there's a supply and demand issue going on. Can you tell us on the ground, what are these industries? Is it every kind of industry, or only certain type of industry, only oil refiners, but not automobile makers, or not restaurants, but commercial buildings? Can you talk a little bit about how that really is applied?
So these systems, cap and trade systems, they typically apply to the actual source of the emissions, so the actual burning of the fossil fuel.
I see.
So if you think about a power plant, either a coal power plant or a natural gas power plant, it's very, very clear, right? That's the source of emissions. Other sectors that are part of it that have meaningful emissions, cement manufacturers, the oil industry, refining is a very meaningful emitter, and then obviously transportation. So everything that actually burns fossil fuels in a meaningful way is a potential target for these cap and trade systems to be included. Now there's differences across the various cap and trade systems out there. Some are broader in scope, like the California market. Some are a little bit more narrow, like the market in Europe. So there's flexibility how much of the industry is actually covered by the cap and trade program, but anyone within those sectors that has meaningful emissions is obligated to take part.
And it's only CO2, methane, and others are not included.
So they're also included. I'm just using CO2. It's basically CO2 equivalents. So these other greenhouse gases are translated basically into how much CO2 that would equal to.
I see.
And then that is also part of it.
So I'm thinking cattle farmers,
Yes.
That's going to be tough because the amount of emission from cows and what have you is significant contributor over time. I'm just thinking, I'm not even sure you know the answer, but I'm just curious, how does one deal with things that cap and trade makes perfect sense if you're able to do something to reduce it? But if the only way to reduce it is to kill off all my cows, then I'm out of business. Well, how do we go about thinking about that?
I guess the first point to make is that typically agriculture is actually excluded.
Oh, okay. That's one way to solve it.
That's one way of dealing with it. But I think maybe this is just one good example of a larger problem that as successful as we want these systems to be, and as much as we want to reduce gross emissions, chances are there are some activities that are going to be super hard to abate for us. To get those gross emissions to zero is going to be very, very difficult. And so the idea is that we're going to try to get them as close to zero as possible.
Yeah.
For those quantities that we cannot solve for, and cattle might be one of them, right? We want to have offset activities, similar to how the voluntary markets work.
I see.
Right. So that we at the end of the day get to a call it net zero outcome, but still try to do as much as we can in terms of reducing the absolute emission levels.
Talk to us a little bit about as an investment. Now we know what we're trying to accomplish.
Mm-hmm.
How do you make money with this cap and trade program that end up doing good? Well, hopefully it's do good for me as an investor as well as doing good. Can you talk a little bit about how that works? And it sounds like
Sure.
I'm scratching my head, and how do I make money in this thing?
We talked about the cap and trade, but really I was focusing more about the cap aspects of it, not the trading aspects of it. And so let me maybe conclude that there needs to be a trading aspect to this and a price discovery aspect. So these permits, they are supplied to the industry primarily via auction. Some are also allocated, but primarily via auctions. So it is the market who is ultimately bidding for these permits and is ultimately, creating the price, setting the price, what a permit is worth. So it is not the regulator, not the policymakers that are setting the price, which is a big difference relative to, carbon taxation.
Okay.
So that makes it much more efficient. And basically the cap and trade systems, the trading aspects, allow emission reductions to happen at the most efficient places of the economy. It doesn't matter where exactly they happen within the economy, as long as the total is going down. But the trading aspects facilitate that transfer of allowances. There's the primary market, the auctions, where you can get your allowances. You bid for them. Hopefully you bid enough so that you actually get some. But even if you didn't bid in enough, you have a secondary market where these allowances are being traded, a spot market, if you want.
So let me just stop for a second for me to understand. The primary market is from the issuance of the government selling, right? Yeah. And we as public can buy it or whatever. Secondary market is once it's off the government, somebody owns it, then sell it again. That's the secondary market, right? Is that correct?
Exactly right.
Okay.
Exactly right.
Okay, thank you.
And to be part of that primary market, you need to be part of the program, and it's a regulated program, so you need to apply to be part of the program. Now, the public may apply and can participate, right? So it is not just compliance entities, the industry that is part of the program, financial participants, individuals may be part of these programs generally, but you need that approval to be part. You need that successful application. Otherwise, the regulator is not going to let you participate.
I don't want to use Bill Gates, but assume I'm a wealthy man and I happen to be the name Bill Gates, and I come and I can buy as much as I want, or is there like an allotment, or I can only buy so many? How does that work?
There are limits to how much you can buy, and then they're different from market to market. I want to say some of the most severe limits that are put on how much you can buy and really how much you can own, how much you can hoard if you want.
Yeah,
are in the California market. So the California market is a market where there are holding limits, strict holding limits in place that limit the quantity of allowances, permits that any entity may own, independent of whether that entity is a compliance entity and emits carbon and therefore needs these permits to operate, or whether it's a voluntary market participant.
So once I buy it, I don't have to sell it. Once I buy it, I don't even have to use it. I say I want to keep it, and I'm not going to sell it until 5 years from now. Let's see what the price is, and the secondary market, and I can sell it. Is that correct? It's almost like baseball cards. I mean, I collected them, and I can trade them later.
Yeah, similar. I mean, yes. Key of these markets is that they're fungible over time. So a permit that was issued, let's say in 2015. Can be used later. And so, there is an incentive. If you wanted to hedge future emissions, you can do that. You can do so. Lock in today's price. And with the idea behind that, you already know that the supply is going to massively decline going forward so that we meet our very ambitious greenhouse gas targets. Mm-hmm. So very likely, the supply-demand balance is much tighter in the future. And very likely leading to a meaningfully higher price of these permits in the future versus today. And that's the idea behind investing in them. Investors, want to potentially participate in that expected price appreciation of these allowances.
So the carbon market, as I understand it, almost like it's a commodity. These credits are like a commodity. Right.
Exactly.
So it depends on supply and demand, and depends on scarcity. And I know this is naive. Sounds like you start out here and you get less and less and less. So the total amount over a period of time, the average per year is getting lower and lower, even though cumulatively you have more. But if you as the industry or you as a company that don't keep up with it by reducing your carbon footprint, right? Mm-hmm. Then you need to buy the same number. Let's say you didn't do anything, then you need to buy the same number of credits, but this year the credit is less than last year, and the demand for it, let's say, is the same as last year. Then in essence, you're paying more per credit. until such time it's just so painful that you've got to do something about it. Is that the incentive?
That's exactly right, because the total quantity is limited. And if a part of the market did not reduce their emissions and is willing, to just buy more of these allowances, the price is going to increase until somebody else is willing to reduce emissions, because total emissions can't be over the cap, right? So you're basically price is going to go higher until somebody's getting priced out of the market.
So how do I lose money in something that seems like it's structured to make money? I'm a little lost. Is it always going up? Okay, go ahead. Sorry.
No. So it's a commodity market. It is supply demand driven.
Right.
The supply is basically predetermined and fixed over a certain time period, right? Like what the supply and how the decline function looks like in the coming years. What is not fixed is the demand side. So the demand side is responsive to GDP, to growth, to something like a COVID crisis, where suddenly we can't go to the office and need to stay home, and we're not using our cars, and so we don't emit carbon, right, by burning fossil fuels. So basically, the volatility in the demand is really driving the volatility in the asset, and it can have meaningful volatility. So carbon is a fairly new market. The first market, 2005, the European market, the first ETS that was established, and that market has a meaningful volatility of 40%ish. The California market a little less volatile, but still in like the 20% range. So you do need to expect volatility in the carbon price, even though the even stated goal by the regulator is a steady increase in the carbon price. But I guess the definition of steady can be stretched a little bit here.
So what you're saying, this is a demand-driven volatility that really have two ways. It's exogenous, such as the COVID event from outside the system that causes us to change our consumption behavior, which changes the production behavior, thus changes the carbon footprint. The other is endogenous, where each company is saying, we don't want to pay for these silly things at these prices. We got to start lowering, so we buy less. Is that those are the two ways to sort of think about demand for these carbon credit?
Yeah, and then I think I would add like just general economic trends, like population growth, changes to miles traveled, things like that, or GDP growth. Those also have a more incremental impact on demand that's slower moving, but over a multi-year period, they can also be significant.
We're trading carbon, so you talked about we're buying it with a certain amount of money that is set by auction. Right, so there's an auction market that buyer and seller come, or primary market. There's no seller, just buying from the primary issuer, which is government, right? And it sounds like we are stroking checks. What are they doing with that money? Are they planting trees, or are they what? Is there something positive out of that, or is it just into general funds and they just go spend it whatever the way they want, or what's going on there?
Yeah, so I mean, generally speaking. Whether it's a carbon tax that is put in place, or a emission trading system, a cap and trade system, where you're auctioning allowances, permits, and generating revenue through that. There's a decision to be made what's going to happen with that money, and the legislators are basically free to choose what they want to do with it, and so there is the option of just letting it flow through to the general budget. But typically what we are seeing is that those revenues are typically used to further good, I want to call it, kind of ESG causes. In California, for example, basically all of the revenue generated is flowing through to projects like, call it affordable housing, public transportation, clean energy, planting of trees, like generally, I want to say projects that have a positive impact. And so California is maybe a little bit extreme in like that they're using basically all of the revenues for that. Other jurisdictions are typically still using a very large share of those revenues for those types of projects.
Where else do we have this cap and trade? Is in Europe they have cap and trade? Can you tell us a little bit where else in the world?
Yeah, so there's a number of cap and trade markets out there. They have different histories. Europe is the oldest one. 2005 is when it was launched. Here in the States, we have basically three today. California, the largest. Then there's the Regional Greenhouse Gas Initiative in the Northeast. A collection of states there are regulating power sector emissions. So it's a more narrow system there versus California is a economy-wide system. Washington State just came out with one, but also kind of other countries internationally. There's more and more cap and trade systems being established. China launched their program. It's kind of call it pilot phase still, but they are serious about it. New Zealand has its program. South Korea has a program like it.
Interesting.
So there are more and more being established worldwide.
So do you envision one day that at different places you will look to incorporate in your investment, particularly that you will say, well, gee, it would be nice to have some California, some Europe, some South Korea. They may have different characteristics that gives for further diversification.
Yeah, clearly there's definitely a strong case to be made to look at the carbon markets worldwide. All the ETS systems out there essentially work with the same principle that the cap is reduced over time and fairly quickly, and therefore there's an expectation that the market increasingly tightens and the prices to go up over time, right? So it should be beneficial to be allocated across. Now, obviously, there's differences between the different markets, and some markets are a little bit more attractive than others. And so we are looking at all of these markets, all the tradable markets out there, following them. And California, in our view, is by far the most attractive, has the most interesting reward versus risk balance of all the carbon markets out there right now. But obviously that can change over time. So it's definitely something that you wanna follow and basically keep an open mind.
So Klaus, you mentioned about this California market, and you mentioned the California market being somewhat special or unique or different. I don't understand that. So can you spend a little time explain to us how that is the case?
Yeah, sure. So look, we are focused on the California market. We see the strongest opportunity there, and really why we are seeing it. There are a few differences in how that market is set up that are contributing to the attractiveness for investors. So some of the key differences are, one, it's a much broader market than, let's say, the European market. So you have 80% coverage versus about 45% coverage of emissions in Europe. And the idea behind it, like why that is positive for investors ultimately, is that the question is, what is the marginal cost to abate? And the broader the program is, right, the more options you have to abate, and ultimately the higher the chance that the very expensive to abate activities are part of that program and ultimately drive that marginal price. So that's good for the very long-term price view. Then California, when setting up the program, right, like cap and trade is meant for the price discovery being driven by the market. But California put a few guardrails around that you don't necessarily see in other markets. And so what they put in place is a floor price under which they are not selling allowances via auction. And they also put a ceiling price in place, at which point basically allowance supply goes unlimited. So it basically puts a cap on the maximum price for allowances. Floor and ceiling, they are increasing at a rate of inflation plus 5% per year.
Oh, wow.
So that kind of reflects the ambition and the goal of a steadily increasing carbon price over time. And the impact for investors is that the floor price basically determines for most feasible scenarios, determines your downside. And because we are not trading very much above the floor price today, in a few years' time, let's call 5-6 years, the floor price is going to catch up with the current market price because it escalates at CPI plus 5 every year, right? And therefore, if you have a certain holding period, that essentially eliminates your downside for most scenarios. So that provides a very nice and attractive asymmetric return outcome with very limited downside. Downside over time is even positive because the floor price continues to escalate at CPI plus 5, and very meaningful upside because that ceiling price is a factor 2 to 3x above the current market price. And so that really drives the big difference between California and the other markets in terms of why we would want to allocate there. Then I guess maybe a question of, well, why is that the case? One of the reasons is California's got this very strict holding limit where you can't freely buy as many allowances as you want. So it is not sufficient to have a small number of educated, well-resourced, capitalized players to bring the price to where it needs to be. In California, you need a very large number of small players to do the same thing. So it's a less efficient market at the end of the day. But that inefficiency can be helpful for investors making those allocation choices today.
That is the primary market. So you have a primary account of a floor and a ceiling, and the increase is whatever price plus 5% or what the inflation.
Yeah.
That must have some influence over the secondary market. But the secondary market, I assume, has a wider range, right? Because it's not.
That's right. The secondary market is not bound. Yeah.
But it must have influence over the secondary market because you can buy from primary or secondary. If you don't have enough or you couldn't quite buy from the primary because you, for whatever reason, you needed more, you can go to secondary market to buy it. But secondary market is probably informed by the primary market. And yes, it may not quite fit those guidelines, but it's not a wide range, or can it be much wider range, or what's your thought on that?
Yeah, so you would expect the secondary market to be within those upper and lower boundaries. Now, there have been exceptions to that. One example would be the height of the COVID crisis. Basically, everybody was looking for cash and selling any and all risk assets, including carbon, including CCAs. And the secondary market price plummeted below the floor.
Yeah.
But then this floor price mechanism basically kicked in. The next quarterly auction happened, and the supply in that auction was meaningfully lower because hardly anyone wanted to participate at auction and buy at the floor if they can just turn to the secondary market and buy below.
Yeah.
Right. So the demand basically moves from the primary market to the secondary market, and then quickly drives up the secondary market price to at or above the primary market.
Arbitrage,
so that's kind of how that
arbitrage it away, right? Arbitraging it away, the price differential.
Right.
Is there any inflationary aspect to this? Is inflation? I mean, I don't even know how I would think about inflation in this case.
So that's actually, I think, a super interesting topic as you're, thinking and discussing carbon markets, because the idea of pricing carbon to change behavior is at its core a inflationary idea.
Yeah.
The change in behavior is going to happen at the end user stage. So let's, simple example, if gasoline gets very expensive because of the carbon price, let's say, then eventually I'm going to change behavior, right? And I'm going to sell my internal combustion engine car, buy a EV, and I'm no longer exposed to that. But that just, that means that the price of gasoline just massively increased.
Mm-hmm.
So it is that, created, intended inflation that is ultimately leading to the behavioral change. So yes, carbon pricing is inflationary, and it is a new risk factor that we all need to learn how to deal with. impacts our purchasing power, impacts corporations' P&L. So that's something that we increasingly need to think about, and think about ways that we can manage that new risk that didn't exist 10 plus years ago.
What I do, we manage client portfolios through traditional means of asset allocation, looking at different asset classes, stocks, bonds, cash, private market, public market, and put them together in hopefully a prudent and smart way to minimize downside risks through diversification, and try to maximize within every unit of risk that we take, maximize the return. This is a new market, or a relatively new market. In fact, it's a relatively new asset class. It didn't exist, 100 years ago, or even 50 years ago, or even 30 years ago, that you can trade in such a way, trading carbon. Let's talk a little bit about the three benefits that the carbon market or carbon trading adds to a portfolio. Can you talk a little bit about that? I think there are three things. Inform us a little bit about that.
Yeah, so I would say, the three key reasons for why you would want to consider an allocation to that space is one, price appreciation. So, you have a positive outlook on the asset class. It's promising to make you money. Two are portfolio construction or diversification aspects.
That's right.
It's an asset class that really has different fundamental drivers relative to most of your other risk assets that you own. So it has low correlations to these other risk assets and can improve your overall portfolio characteristics. And then thirdly, it is a tool to manage a new risk factor that we're all facing now. And you can call this risk factor inflation, because carbon pricing is directly inflationary. Yeah. Or you can just call it, the impact of carbon pricing on corporates' P&Ls, right? So corporations are also facing the carbon price. Yeah. The resources that they buy are impacted by that, and they can have an impact on the P&L. So that flows through to our asset valuations. So we as allocators are impacted with this new risk factor. And the question is, how do you manage that? And having an allocation to carbon is one way of mitigating and managing that new risk.
So it's almost like a risk neutralizer to some extent that's related to this sector, right? Yeah.
Well, neutral is a strong word, but it is okay. Definitely something that can help you manage it.
Some portfolio positive attributes to yes. Those words have to be very careful how we think about it, because it had different implications. Klaus, thank you so much, and maybe we can do this again as there are more excitement in the carbon market, and as more countries get into it, to have an episode 2 to learn about what's new and how they're different, and how currency may come into play, and all the other things that make it more complicated. But unique is an often overused word, but unique in terms of asset class, in terms of a new thing. That perhaps we can all be capitalistic about and make money, and the fact that it also do good is a wonderful byproduct for us all. So, Klaus, thank you so much. Really enjoyed our conversation today.
Philip, thank you so much for having me. It was a pleasure.
You can always find more episodes by visiting philipchow.us/podcast, or find us on your favorite podcast app. You can always leave us feedback, ask questions, or request a topic for us to discuss by sending an email to pc@philipchow.us.
Views expressed in the Tao of Chao podcast are individual opinions, and they do not represent the employers of each guest or the firm each guest is associated. Our podcasts are for educational and informational purposes only and should not be deemed or viewed as investment advice or recommendations. Please consult your personal financial advisor, investment expert, or investment fiduciary before taking any actions about your plan and investments.